All right, it is the last trading week in September. We had 5 trading weeks in September, and this was the start of September right here. Just straight to the downside. We're clawing, we're hanging from a cliff at this 43.30 spot, just hanging on for dear life. Once we break that, then it's gonna go down pretty quick. This was yesterday, dipped under, stayed right at that level, and then bounced off the level a little bit to close out. But then we're probably gonna open to the downside, and it's probably gonna look something like today. This is one of these days where it's just hard to trade, hard to find opportunities. So what I'm gonna do is I'm going to talk about ETFs. So, ETFs, you've heard of them. They're exchange traded funds. Warren Buffett talked about them. He said that you should just buy a S&P ETF and just sit on it. So, one of the popular ETFs that I play with or I trade is XLU. XLU is utilities ETF. So, this is what it looks like for yesterday. I could have bought it at this 62.50 level and then sold it at this 62. I could have sold it at the close for 63.21, and this would have been a day trading profit. So it trades like a stock on an exchange where there's buyers and sellers. So if you want to get your money back, you just go into the market, hit sell, and that's it. No penalties, no nothing like that. Let's look under the hood a little bit. Under the hood here, this is XLU currently trading at 63.20. You got a bid and a ask, just like a normal stock. You have an expense ratio. This is not like a normal stock, so this is what it costs to run the fund. 0.10, extremely low. You have the yield here, 3.34. You have an ex dividend date, just like a stock. So you can jump into it, jump out of it, jump into it, whatever you want. And let's take a look at some of the holdings. 100% in utilities, and that's because they don't carry cash. And the reason why is because um, they don't need to. There's no redemptions. You have a seller immediately, or the market makers make you a seller. Or so let's take a look at the holdings here. Let's Next Era Energy, Southern, Duke Energy, all top notch energy companies. Dominion, Exelon, Constellation, all the usual suspects are in it, and that's basically ETF, exchange traded fund. See, 95% of the assets go into the utilities, water utilities, electrical utilities, and everything like that. Now, let's look at an actual mutual fund. So, this mutual fund here is a utility mutual fund. This is what you can get at your broker if you want. This is probably what your broker is going to use to do utilities. Not going to use an ETF. The reason why is because all you can charge on an ETF is a trade fee. A trade fee. Those aren't very lucrative at all. However, these are a lot more lucrative. So let's take a look. This is a Franklin. Let's copy that. Put this in and see what the chart looks like for this. And I'll show you the difference here. Come on. All right. Hit that. There it is. Franklin Utilities. You see yesterday, it's just flatlined. There's a price, but it's just a flat line. And that's because this price comes at the end of the day when they see how much was taken out, how much was bought, how many value or what the value of the assets are. So it's called net asset value, NAV. And they determine that at the end of the day. So if you look here, see this? This is where they're determining at the end of the day how much assets they have versus redemptions and buys. So chart very similar to XLU, but it's a little more choppy because they do it by the day, not by the minute. Let's take a look at XLU, same time frame. You can see it's very similar chart. And why would it be a very similar chart? Well, let's take a look. So here's the NAV. Price is 1983. They, anytime you buy in, they charge you this pop. This is the price to buy in. This is the public offering price. So if you were to get new shares, this is what you would pay. Now the reason why is because of a initial charge. This initial charge of 375 is to get into the fund. Get into the fund up front. So if you have $100,000, it's going to charge you $37.50 to get in the fund. Gross expense ratio 0.82, and that's because they're buying and trading and operating the fund. It's actively managed. Here's the CDC or CDSC. This is a deferred sales charge if you were to get out. And then here's a 12B1 fee. This is what they pay your broker. So every quarter they pay your broker and for a total of 0.25 a year. So if you have 100,000 with them, they're going to get 0.25 to manage your money. Now, let's take a look. Here are your money managers. If you click on this, it'll show you all their credentials. The reason why is because it's actively managed, so you have to trust who your CFAs are, certified financial analysts. Let's see. See how they have different shares here? With sales charge, without sales charge. Class A is going to be what's for your retail investor. They have an advisor class. They have a class C. Class C is deferred sales charge. You get 1% every year. So if you're going to buy and hold it, it's better to get the A, the 3.75 up front. Some of these other classes, like this R6 advisor class, are for like pensions, nonprofits, or big, huge companies, stuff like that. Those, they get special prices. This has been in actively managed since 1948, and that's why they have this amazing up chart here. But let's look at the holdings. Look at the holdings here. NextEra Energy, Southern, Edison, Sempra, Duke, all the same exact holdings. Same exact holdings. So basically what you're paying for is the peace of mind of having it actively managed, and peace of mind that your broker will pick good actively managed funds. So you got two layers of protection there. You got your advisor who could get you out of it or make a good decision, and you got the active manager of the actual assets inside of the fund, and that's what you're paying for. Now, as somebody who was in the industry as a financial advisor, I do ETFs. They're cheaper. I can jump out of them. I don't get charged, and I look at my account every day, so I can jump out of it or jump into it whenever I want, and that works for me. So you have to pick what's best for you. If you're going to be looking at it, if you're going to be buyer and hold, if you're not going to look at it, if you want an advisor, if you want actively managed, you're going to pay for all those services. So that's what these shares are for. That's what mutual funds are for. So that's ETF versus mutual funds. It's on you to make that decision. I am a huge ETF fan though.